Good morning and welcome to you all. Welcome to Altamir's half-year results presentation. I'll now hand over to Maurice Chenio, Chairman and CEO of Altamir Gérance, and Eric Sabia, our CFO.
Thank you very much, Claire, our Investor Relations Manager. So first of all, I'd like to draw your attention to the fact that we're breaking new ground this year, because until now we've been holding SFF meetings in person and we've decided to hold them as webinars. So we're breaking new ground, so please let us know if this new way of doing things suits you, because we'd be happier to have you in person. But recent experience has shown that people find it very hard to get around. So we've decided to opt for the webinar. I don't need to introduce you to Altamir, which was created in 1914. So we're getting close to 28 years old for Altamir. I'm going to start my presentation by focusing, as we usually do, on the private equity market and in particular buyouts in Europe. And as you may have read in the press, the figures this time confirm what we've been reading in the press, namely a significant drop in investment volume, with 73.5 billion invested in buyouts in the first half of the year. This is obviously a far cry from the 350 and 470 billion invested in the two record years of 21 and 22. But if in the second half of the year 23, which is quite likely, we achieve the same score as in the first half, we'd be back to the scores of the years 2017 to 2080, back, let's say, to normal, since 21 and 22 were exceptional years in terms of investment. In terms of divestments, the drop is even more significant. The market has virtually ground to a halt, with 50 billion in divestments compared with 168 billion last year, which was already a very bad year, and 250 billion in 2021. But here again, if we were to double the volume of divestments in 2023, we'd still be a long way from the figures for 2017 and 2020. I would remind you that in private equity, there are two other types of exit, IPOs and recapitalizations by refinancing debt. And obviously these two sources of financing are also drying up at the same level as what we see here in terms of mergers and acquisitions. In this context, how is your company performing? They're in line with the market, you might say. The first thing I'd like to point out is that we've returned to growth. Taking into account the dividend paid in May, our net asset value is up by 0.9%, which is much better than the -2.7 of the first half of 2082, driven by EBITDA, which is up by 1.4%, compared with 14.9% last year. But you'll see that this 1.4%, by the time Eric comments on the bridge, has a very significant impact on portfolio value creation. Divestments were in line with the market, with 12 million divested compared with 85 million in the first half of last year. Only 2 new investments compared with 5 in the first half of last year, and 38 million invested compared with 95 million in the first half of last year. Our cash position has obviously shrunk accordingly, since if we invest more than we divest, it obviously makes a difference. So if we look at this on slide 14, when we look at the details, you can see that the 12 million in divestments in the first half of the year, broken down into 7.4 million for 2 full divestments and 4.5 million for partial divestments, are a far cry from the record figures of 2021, of course, but of 2022. and even of the 1920s. So it's going to take some time for us to get back to a significant volume of divestments. So in detail, on the next page, the 7.4 million comes mainly from the portfolio companies of the Apax LLP funds, with 2 complete exits, Duck Creek Technologies, where overall we made 5.1 times our stake, and the divestment of Shriram, which is a non-financial bank in India, where we only recovered a little less than our cost. In terms of partial exits, we refinanced 4 or 5 companies, resulting in 4.7 million proceeds. In terms of new investments, the situation is a little more pleasant, with 30 million in new investments in 2 new transactions and 7.4 million in additional investments. It's going to take some time, 2021 and 2022, even after the 2 hot years. In detail, a total of 37.7 million was invested in new projects. I would like 30 million of which are new investments, to first and foremost in IBS Software. This is the first investment of the Apax LLP fund, in which, as you know, we have subscribed 254 million. So this fund is now up and running. And from now on, all new investments made by Apax in London and the United States will be made through this vehicle. IBS Software is a leading provider of SaaS software solutions for the logistics and tourism industries, including airlines, travel agencies, and cruise lines, a software sector that is well known to Apax LLP. The second investment was made through Apax France Mid-Market DIX, which, as you know, has been renamed 7.2, and Infraneo is a major player in the European engineering market, specializing in diagnostics and consultancy in the field of infrastructure asset management, in particular to remedy their aging and the impact of climate change on their integrity. So it's a double coup, since on the one hand, it's obviously a financial investment, but it's also an investment that takes an ESG approach to climate change. Added to these 2 new investments is a further 1.2 million, which is the final amount we invested in Vita Protech, a recent investment by Apax 7.2 Mid-Market that we had underestimated at the time of a previous report. In addition to these investments through the Apax LLP and Apax 7.2 Mid-Market funds, we also account for investments through our own funds, ALTAMIR S1, in which we have invested 30 million euros, is currently 60% invested, and has made 21 new investments over the half year for a total of 2.1 million euros. Apax Global 22, in which we have invested 40 million euros, made 1 new investment during the half year and is currently 16% invested. Apax Digital 1, which we're not talking about, made no new investments in the first half, but the company is fully invested at 100%. Apex Digital 2 made a new investment and is currently 18% invested. And finally, Apax Development, in which we invested 15 million euros, 20 million in Apax Digital 2, has made a new investment and is now fully invested. In terms of follow-on investments, there is in fact a figure of 7.4 million, but this is to some extent skewed by the fact that we made a negative adjustment to reflect the fact that this time we had overestimated the amount we were going to invest through Europe Snacks in Bird, Snacks by 3.8 million. So in reality, we made 11.2 follow-on investments, and the vast majority, 2/3, are for, in a development perspective, 2.3 million to facilitate the migration of Odigo into SaaS, 1.5 million in crystals buildups, 1.3 million at Lutech to finance an acquisition, likewise 1.2 million in Destiny's build-ups, and so roughly 2/3, and the rest. The third is more defensive in Vocalcom, Matches Fashion, and Bayer Medical. So all this translates into, we show you on slide 19, the evolution of net asset value per share. So after almost 10 years of uninterrupted growth, since December 31, 2021, our ANR has been falling, although we're pleased to note that in the first half of the year, we've picked up again. The drop is mainly due to the payment of dividends, of course, where we paid out around 40 million in dividends each year. So as regards the change from 2022 to 2023 on June 30th, I'll hand over to Eric, who will explain the bridge on page 20.
Thank you, Maurice. How did we go from net assets at the end of December to net assets at the end of June? The first reason is value creation. We created 35.4 million in value over the half year, representing a return of around 6% on NAV at the end of December. This value creation was negatively impacted to the tune of 8.3 million euros by an unfavorable currency effect, mainly linked to the evolution of the dollar. Since we created value over the half year, we had to book the provision for additional carried. So the provision for carried had a negative impact on sales of just under 3 million euros. We also had to pay direct and indirect management fees, i.e. all direct and indirect fees for ALTAMIR and the portfolio, amounting to just over 21 million euros. We have a positive financial result this year, whereas it was negative in previous years of 0.6 million euros. And as Maurice mentioned, due to the payment, detachment and payment of the dividend in May this year for 39.4 million euros, this has a direct impact on net assets, and we arrive at net assets at the end of June of 1,284 million euros. If we look a little more closely, and I'm sorry I forgot to mention something on the previous slide, I'd like to draw your attention to the fact that we had to book an adjustment on the 2022 accounts, and which impacts the creation of value by 12.7 million euros. It's a correction of 2022. It has no impact on net assets. If we now zoom in on the value creation achieved over the half year on page 21, highlights include the traction of the consumer sector, which created value of 49 million euros, mainly due to Europe Snacks and Tom, which contributed 14 and 34 million euros respectively. The healthcare sector accounted for 5.6 million euros, mainly due to Mental Beta and Rodenstock respectively. And these two positive effects were partially offset by the tech and telco sector, which fell by 12.2 million euros, mainly due to the decline of the three companies you see at the bottom, Vocalcom, ThoughtWorks and Infovista, fortunately partially offset by the strong half-year growth of Marlink and Greatech. Lastly, in the services sector, there was a decline of 7 million euros, i.e. a negative impact of 7 million euros on value creation, mainly due to Entoria, which you can see at the bottom of this page. If we now focus on value creation on the unrealized capital gains side, i.e. The unrealized part of value creation over the half year, it is entirely linked to EBITDA growth. Even if we only have 1.4% EBITDA growth over the half year, this figure conceals disparities which still enable us to post value creation and an effect of EBITDA growth of 150 million euros over the half year. The multiple effect over the half year is practically nil at 5 million euros, and the fact that we have slightly lifted the portfolio and re-injected cash, and the effects of management packages have a negative effect of around 100 million euros. Which brings us to a figure of 48.1 million euros of value creation on the part we still had in portfolio at the end of June. On the right-hand side, you can see the change in portfolio value at the end of December, from the end of December to the end of June. And we can see that since we have, as Maurice was saying, made few sessions, and yet we have continued to invest and create value. The portfolio has grown by 5% compared with December 31st, to stand above 1.5 billion for the first time. We are now at 1.541 billion euros. On the next slide, page 23, this is an indicator that we monitor closely. And I would remind you that we try to be systematically invested to the maximum, because being invested to the maximum enables us to maximize value creation over the long term. And we are at 105 million euros as at June 30 in the company's net worth. But what cash is this figure? 105%? Sorry, 105% of net worth at the end of June. But this figure is a little skewed, since we can see that the portfolio is stable at 943 million versus 941 million at the end of December. This is more to do with the fall in net worth from 946 to 901 million euros, impacted mainly by the dividend. On page 24, we present the different valuation methods we have used for the portfolio. And we can see that at the end of June, 90% of the portfolio is valued using market comparables. 6% of the portfolio is at cost, and the weighting of listed companies is 4% versus 5% at the end of December, thus stable overall compared with 6 months ago. Page 25 shows the trend in uplift, which was not significant over the half year with very few sessions, 6 and 7 respectively. So even if the figure remains positive, there's no particular mention to be made of uplift. On the next page, page 26, we present the residual commitments at the end of June, which amount to 670 million euros. And of this figure, practically 115 million euros have already been invested by the funds in the portfolio, both the 7.2 mid-market funds and the Apax LLP funds. 115 million euros have already been invested, but not yet called up at ALTAMIR level, as financed by credit lines. And these 670 million euros can be broken down into the 3 blocks: the 2019 allocation for 377 million euros, and the 2023 allocation for 254, plus a small remainder on the previous allocation. You have all the details on the slide if you want to go into the figures in detail. On the next page, page 27, we show you the cash situation. We estimate that ALTAMIR has the appropriate financing and that we have a cash position in the parent company financial statements of 51 million euros. And to this 51 million euros, 115 million in credit lines, which break down into 75 million for ALTAMIR and 40 million for a dedicated SPV. And we are currently working on increasing these credit lines from 115 to 135 million euros. I'll now hand over to Maurice, who will tell you what's been happening over the last 3 months.
Thank you, Eric. So first of all, we'd like to remind you that we have very little or virtually no exposure to Russia and Ukraine, since this conflict is unfortunately still going on. And as far as post-June 30 events are concerned, the only really significant news is a second investment through Apax LLP's ONZI fund in a company called Palex, which is an independent distributor of innovative medtech products for public and private hospitals and laboratories in Southern Europe, Spain, and Italy. If you don't mind, we're now getting down to the nitty-gritty of what makes your company so valuable, namely the quality of its portfolio. First of all, on page 30, we present you with an overview of 68 portfolio companies. I would remind you that portfolio companies only include those held by the Apax LLP or 7U funds and held as direct co-investments, but do not include companies held through the Apax Digital I and II or AltaRock Global XI, X3 or Apax Development Funds. There are a considerable number of companies here. Still, we're only counting the ones we're presenting to you, the 68 companies with a value of 1,541 million, as Eric was saying a moment ago. So this 1,541 breaks down into 17% in what we call direct investments, either investment in TOM or co-investment alongside the Apax LLP or 7.2 funds, 54.4% through alongside 7.2 and 27.1% alongside the Apax London funds, and then 1.3% alongside the AltaRock Global funds. This amount will obviously increase over time. As far as the breakdown of the portfolio is concerned, we present it to you by sector, so you can see that it's fairly balanced, with tech and telco still leading the way with 43%, followed by consumers, since here we're at fair market value. And so with the strong appreciation of TOM and the strong appreciation of Europe snacks, the weight of consumers has obviously increased. Services remain at 22% and healthcare is at 6%. by vintage, by age. The portfolio is quite well diversified, as you can see. And so this is very important for managing exits. And finally, from a geographical point of view, 70% of our business is in Europe. So in this presentation, we don't just look at where the head office is, but where the business is deployed. So if I take an example like Marlink, where the company was headquartered in France, but generates most of its sales worldwide, it's not sales in France that are taken into account, or Europe, but sales broken down by geographical area. So we have 70% in Europe, 22% in North America, and 8% in the rest of the world. I would remind you that this figure is subject to a constraint, since Altamir is a venture capital company, and we are therefore obliged to have at all times more than 50% of our portfolio invested in unlisted companies in the European Union, which creates a constraint in terms of geographical diversification. As you know, Altamir's strategy is to invest in growth companies. And our way of demonstrating this factor was to compare the EBITDA growth of our portfolio companies with that of the 35 non-financial companies in the CAC 40 index. You can see that, historically speaking, it's true that the gap has narrowed over the last 2 years, well, since 2002, 2003, but things will soon get back on track. With regard to portfolio growth, for your information, we have given you a breakdown of the portfolio, explaining that of the 68 companies, 36 of them, representing 84% of the value at cost or 88% at fair market value, experience positive sales growth in what is, as you know, a turbulent world. The figures are a little less positive, but almost the same. 32 companies representing 68% of the portfolio at cost or 78% at fair market value saw their EBITDA grow, and 21 of them, representing 9% at fair market value, saw their sales or EBITDA grow by more than 20%. As far as the evolution of enterprise value multiples is concerned, as for debt multiples, you can see that the situation is settling down, i.e., the valuation multiple is slightly down at 14 times versus 1435, but on a broader sample of 88% versus 77% at December 31, 22, and the debt multiple continues to rise slightly, but again with a much larger sample size of 94% versus 85% at December 31, 22. Another way of looking at our portfolio is to look at the 20 largest investments, which represent 73.6% of the portfolio's net asset value at fair market value. So I'd like to draw your attention to two things. Firstly, the fact that Tom today carries a very significant weight at 15.7% due to its performance, and despite the fact that we've already recovered 40% of our cost, and then we're back to relatively balanced levels. And I'd also like to draw your attention to the fact that of the 20 companies, only 2 of them, namely InfoVista, which is valued at 45 million against a cost price of 50 million, and Entoria is valued at 34 million against a cost price of 54 million. These are the 2 companies that are valued below cost, while all the other companies are valued above cost, and often very significantly so, although when grouped by sector, all sectors are in the black. So, as usual, I'm going to comment briefly on the performance of the 20 biggest companies in our portfolio, organized by sector. So if I start with the telco sector, I'll remind you that Destiny is a provider of secure communication solutions in the cloud for innovative companies, mainly in the IP channel. As you can see, the figures are very pleasing, with 26% growth in sales and 24% growth in EBITDA. But what's interesting to note is that Destiny, which started out in Belgium, is now the leader in Benelux, the leader in France, the leader in Sweden and Denmark, and has just penetrated Germany. So the company is developing extremely positively, both organically and through external growth. Marlink, I would remind you, is a company we have exited and reinvested in alongside Providence. The company also continues to perform extremely well, with 20% growth in sales and 30% growth in EBITDA. All market segments are growing, and most importantly, as you know, Marlink buys satellite capacity and then buys it wholesale and resells it retail, mainly to ships. And there's a disruptive phenomenon in satellites known as low orbit. And so Marlink has introduced Starlink into its offer in order to protect itself against this technological evolution. Greytech, which distributes software for the building and architecture industry, and which has two activities. Firstly, it is the world's leading distributor of Autodesk software, which is the world leader in this field, and which has its own activities, its own complementary software, continues to make very encouraging and significant progress, with 19% growth in sales and 69% growth in EBITDA. Odin, which operates in an extremely small geographical area, Holland, has seen much less market growth, although actions are underway to develop the company both geographically and in terms of its product offering. And the company is working on acquisitions. Infovista, which is the most negative situation in our portfolio after a very successful year, which ended in June 22, had a very disappointing year, which ended in June 23, with a 23% drop in sales. I would remind you that Infovista sells software, but in the form of licenses to telephone operators who have stopped investing. And so this immediately translates into a very sharp drop in sales. So very strict measures have been taken, on the one hand, to reinforce the management team with a new manager and new managers at the head of these companies. And on the other hand, an in-depth work to review the go-to market and the whole cost structure. Odigo, very good news. You know that the investment thesis of Odigo, which is a leader in solutions for call centers and contact centers in large companies. Investment thesis was to transform this company, which had been selling license equivalents, if you like, into a SaaS company. So the migration has now been completed, since 95% of the eligible base has been transformed into SaaS, resulting in significant cost reductions and, of course, greater customer satisfaction. The downside of this is that the management team has been very absorbed by this migration and has not been able to develop sales as much as we would have liked. But now that the migration has been completed, the focus will be on both cost reduction and sales growth. Vita Protect is a new investment for the 7-2 fund. Well, the company is performing according to plan, with sales growth having returned to 8%, and the company is working on both organic growth and acquisitions, of which it made a small one in the first half. Experio is also a reinvestment, since we sold our company to Vitruvian and reinvested. Let me remind you that Experio's investment thesis was that of a global provider of managed internet access to the cloud, and that it was selling at the time. We invested mainly through telephone operators. The investment and value creation thesis was based on going direct to the end companies without alienating the telephone operators, and this thesis succeeded perfectly, since you can see that at the end of June 2023, 75% of the order book was direct with the companies. What's more, there has been a shift towards high value added products, which are also growing faster than simple products. EBITDA is not growing as fast as sales, as we continue to invest in our sales force to deal with customers directly. EFICI. The company is a European leader in CRM software. The startup was a little sluggish, which is why the arrival of a new management team, a new director, should help boost the company's performance. But it has no debt and is in a very fast-growing market, so we have nothing but positive hopes for it. In services, AEB, I remind you, is a world leader in ingredients and services for beverages and food products, mainly wine. Despite a 2% drop in sales and stable EBITDA, the company performed well, as wine production in the Southern Hemisphere fell by 15 to 30% compared with previous years. So in a declining market, this was a very remarkable performance. Optiven is also a recent 7-10 investment in the field of mechanical breakdown management. And here again, the company is in line with its plan, with its investment thesis, despite a very, shall we say, challenging used car market. In services, Crystal is one of France's leading wealth management advisors. I would remind you that wealth management advisors today only account for around 10% of French wealth management, that they are in the process of taking market share from the banks, but that this is an extremely fragmented market, and that Crystal's investment thesis was to consolidate this industry. 23 acquisitions have been made, resulting in significant growth in sales. But on the other hand, EBITDA remains stable, as we are investing heavily both to integrate these acquisitions and to set up the organization needed to manage a group that has tripled in size in the space of 2 years. Entori is another area of concern for us. It is, as you know, France's second largest wholesale broker, specializing in health and provident insurance for self-employed managers and employees of small and medium-sized businesses. The company made a bad acquisition 2 or 3 years ago, financed mainly by debt, which led to a significant drop in EBITDA. A drastic turnaround plan was therefore put in place, which is yielding results, since you can see that after 2022, which was up, the first half of 2023 is up in terms of both sales and EBITDA. But today the company's debt is too high in relation to its EBITDA level, and so discussions are underway with lenders, which has led us to revise Entoria's valuation downwards and even below its cost price. Assured Partners is an insurance broker in the United States that is growing both organically and through acquisitions. And you can see that the machine is still running at full speed, European in the rental and installation of mobile sanitary facilities. The company continues to make significant progress in both sales and EBITDA. A major source of satisfaction. PIB Group is a UK-based specialist insurance group which again operates both through organic growth and above all through acquisitions, 67 of which have been made since the February investment by Apax LLP, resulting in sales growth of 30% and 15% respectively, and EBITDA. Tom, Histoire d'Or, Marcorion, Strolli in Italy and Eurovivo in Germany is the European leader in affordable jewelry. After 30% growth last year, the company continues to grow at 10% of sales when the market is at flats and is growing its bidders at 2% because inflationary factors have not been passed on in prices. The decision that was taken was to keep prices constant in order to gain market share, which you can see by the 10% growth in sales. The other good news about Tom is that, as you'll recall, at the same time as we reinvested in Tom, we bought Agatha at the bar of the court, which we bought in partnership with another partner at 5 years to 50. We bought out this partner, and now Agatha is a wholly owned Tom subsidiary. Above all, the main reason we acquired Agatha was because of its activities. It's a very well-known brand in Asia, particularly in China, Japan, and Korea. And so we've restarted activities in China in a very significant way. I'll tell you more in the next report. Europe Snacks has been given back its real name, which we used to call Snacks Development, and has regained its true identity. As you know, Europe Snacks is a European leader in private label savory aperitifs. Given inflation, private labels are on a roll, and so Europe Snacks is well up to the challenge. What's more, we've just added an acquisition in the UK, Burt Snacks, which has already strengthened our position in the UK, where we're expecting major synergies. And so Europe Snacks is now the undisputed leader in France, Spain, and the UK in private label snacks. Moving on to the health sector, Mental Better, a provider of outpatient care for mild to moderate mental health disorders in Holland, which had previously suffered last year from both therapist and customer absenteeism, has returned to a normal level of activity. And what's more, Mental Better has just acquired its number 2 competitor. So that's why you see sales and EBITDA growth of 23% and 36% respectively, of which 17% has been achieved. In organic. Finally, Candela is a company of Israeli origin, but which works essentially on the American market, selling equipment for beauticians. And the company continues to perform very well. Although it suffered in the first half of the year from its exit, it was one of the few companies with exposure to Russia from its exit from the Russian market. That's it. I've covered the 20 companies in the portfolio, as you can see, apart from Entoria and InfoVista's portfolio of 20 companies is doing very well overall. And if I look at the 68 companies as a whole, there are still only 1 or 2, Matches, Fashion, and Vocalcom, which are the focus of a great deal of attention from our management teams. From funds, If we now turn to Altamir's performance compared with its benchmark, first of all, in terms of changes in its net asset value, you can see on page 39 that over 10 years, 5 years and 1 year, Altamir has outperformed LPX Europe only over 3 years. We've fallen a little behind in the last 3 years, but I hope we'll close this gap soon. Our dividend policy remains unchanged, and we have generally paid out 3% of net asset value since 2014. Taking into account the discount of around 20%, this gives a yield of around 4 to 4.5%. As for Altamir's performance in terms of total shareholder return, i.e. the evolution of the share price, including the dividend, you can see that without exception, Altamir also outperforms the market. Altamir outperforms both the LPX Europe and the CAC Mid and Small, and quite significantly over 1, 3, 5, and 10 years. So in terms of objectives, you'll recall that at the end of 2002, I decided no longer to present objectives for the coming year, but rather taking into account the cyclical nature of our business to reason on an average over the next 5 years. And so we're halfway there, since we're 2.5 years into fiscal year 1 fiscal year 1 and 6 months into fiscal year 1. So we're halfway there. In terms of divestments, I had forecast an average of 230 million, despite the fact that we only made 12 million in the first half of the year, and we're now at 282 over the 2.5 years, despite the fact that we've only achieved 1.4% in organic growth and external growth. In conclusion, over the 2.5 year period, we're at 12.9%. You must still love Altamir, so because we're well in line with the averages I was anticipating, which is to invest alongside the Apax funds, even though Apax France has been renamed 7-2. Our strategy is to support growth companies to give a shareholder return. We have a highly diversified double-digit share price growth with a low risk. As you have seen, 1,541,068 companies, not counting the companies in the funds. There is no leverage. There is no debt at the level of the central structure, even if there is debt. And we have a conservative portfolio valuation policy, since you can see that uplifts are always positive. We have a rigorous cash management policy, and you have an experienced management team and a very attractive tax situation. Since we pay no corporate income tax in shareholders, provided they meet certain conditions, also benefit from very favorable tax treatment. So Eric, Claire, and I would like to thank you for your attention and look forward to seeing you at our next meeting, our next webinar, we'll call it, which will comment on the September 30th accounts. That's right.
No, for annuals next year in March.
We look forward to hearing from you and welcome your questions, comments, and suggestions. We wish you a pleasant evening.